Hello friends, welcome to a quick market update from Invesco Mutual Fund. So the fixed income market is going through some troubled time. So let's do a quick check what's actually happened. So Indian economy has been going through some slowdown for the past few quarters. And obviously we were seeing some actions from government and from Reserve Bank of India in order to address the concerns. But now all of a sudden there is this massive pandemic which has been announced, and the entire globe has been under the weight of this COVID-19. And obviously that is creating panic across geographies, across markets and so on. So we have seen some unprecedented rate reductions by central bankers led by Federal Reserve, where they have dropped interest rates by over 150 basis points, and interest rates have come down to almost like a zero. It is also expected that many other central banks will also follow, and which has been happening. And as per the press releases which are coming out from RBI, even RBI and other MPC members will address this concern by going in for rate reductions down the road. We don't know when, but we do expect that anytime between now and the monetary policy review date. Along with that, RBI has also been infusing liquidity in order to alleviate the conditions, so that the banking sector does have liquidity as and when there is a demand for credit pickup happens. But as of now, it doesn't appear that these kind of demand for credit will be there within the economy, because the economy is slowing down. The growth conditions are getting weaker with every passing week and month. And obviously the market investors are figuring out additional risk in this entire scenario. So how does a fixed income investor position oneself? Now, a fixed income investor at this point in time needs to understand two major risks. The first one is a evolving credit risk. The credit risk has become at the forefront of the fixed income market risk metrics, primarily because the refinancing from the banking sector has actually come down. Banking credit growth has come down to under 7% compared to an historical average of about between 17 to 18%, which is the long period average. What it really indicates is that the bankers' appetite for additional credit disbursement is getting slower. But as we all know, that debt ultimately needs to get refinanced. And if the refinancing is slowing down at the margin, obviously the financial conditions of all the borrowers who are dependent on the banks for their credit requirement actually gets weaker. Hence, we have started to see widening of spreads in each of these credits, and obviously there have been quite a few number of defaults down the road. So how does a fixed income position? Obviously that piece of the credit market one needs to be completely aware, and absolutely if that is the risk one is not able to absorb, then one needs to stay away from that. The second part of the market is the interest rate market. Since the economy is slowing down, obviously we do expect rate reductions to happen, and which has been announced by RBI governor that there is elbow room for rate reductions down the road. So one needs to position for a declining interest income environment. So there is going to be some reinvestment risk. So one needs to overcome that by getting into products whose portfolio duration is longer than their own individual investment horizon. That's one way of overcoming the reinvestment risk. So we would encourage investors to stay safe, stay in the best of the asset classes, which are top-notch AAA rated blue chip credits and some dose of Government of India securities, because they are extremely low on the credit risk and they are best suited to get the benefit of this slowing economy and potential declining rate environment. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.